Welcome to This Explainer. Today, we're diving deep into the actual mechanics of our global banking system, and we're going to take a completely impartial look at a proposed systemic alternative. It's one of those topics that literally affects every single one of us, right down to the prices we pay at the grocery store and the taxes taken out of our paychecks.
Our source material for today is a seriously fascinating book called Breaking the Trap of Debt, Inflation, Interest, and Poverty by Qanit, Khalil, and Sohaib Umar. And these guys aren't just theorizing from afar, they're bringing decades of real-world finance and central banking experience to the table to present a practitioner-led case for completely overhauling how our monetary system operates.
Okay, let's just dive right into this with a question that might seem pretty simple at first glance. Where does money actually come from? Most of us kind of have this illusion that banks simply hold on to our physical cash in a vault, basically acting like a glorified safe. But as the source material reveals, that assumption, it's fundamentally flawed.
To understand why, here's a quick map of where we're headed today. We're going to start with the money creation illusion, move into the debt and inflation trap, explore the full reserve alternative, see how this all connects to Pakistan and Islamic economics, and finally, look at breaking the cycle.
All right, let's get into Section 1, the money creation illusion. We're pulling back the curtain on fractional reserve banking.
Okay, get this, 90%. According to the authors, roughly 90% of all the money circulating in the world today actually isn't physical cash printed by the government. No, it's simply digital numbers created literally out of thin air by commercial banks. Let me just repeat that because it's so wild. Private banks create the vast majority of our money.
So how exactly does that happen? Let's trace it. Under our current fractional reserve system, a bank really only holds a tiny fraction of its depositors' cash in reserve. When someone comes in asking for a loan, the bank doesn't just walk to the back and hand them somebody else's deposited cash. Nope. Through the magic of digital accounting, they basically just type numbers into the borrower's account, and boom, at that exact moment, brand new money is created. The absolutely crucial takeaway from the authors here is that right now, money is created as debt. If you want more money flowing in the economy, someone, somewhere has to go into debt.
Which brings us nicely to Section 2, the debt and inflation trap. Because you really have to ask, what happens to a global economy when its monetary system literally requires continuous debt expansion just to function?
Well, let's look at the data over time. Global debt, both public and private, compare the GDP has been structurally rising for decades. We're talking a jump from 97% in 1950 to a massive 236% by 2024. And the book argues this isn't just because, people or governments suddenly forgot how to budget. It's because the system itself mathematically requires debt to keep increasing so it can create money.
And this structurally rising debt, it triggers a massive chain reaction. The text outlines this sort of systemic fallout, where all this newly created money floods heavily into real estate and financial markets. And the result? Asset prices inflate, the wealthy get even wealthier, and ordinary wages completely stagnate. It inevitably leads to these severe boom and bust economic cycles, the constant risk of bank runs because, remember, the banks don't actually have everyone's money on hand, and ultimately a loss of monetary sovereignty for governments.
To ground all this abstract macroeconomic theory in reality, the authors highlight a pretty stark statistic. In 2023, roughly 14% of the U.S. population faced food insecurity. That is happening in one of the world's most advanced economies. The authors point to this as evidence that persistent, debt-driven inflation acts like this hidden, regressive tax, quietly shifting wealth upward and creating poverty right in the middle of incredible economic abundance. So if the fractional reserve system is inherently unstable and unequal, what's the fix? Let's move to Section 3. The full reserve alternative. Let's neutrally contrast these two systems for a second. Under the current fractional reserve setup, as we've seen, money is created by private banks as debt. The author's core proposal is a massive fundamental shift to full reserve banking. In this alternative model, money is created exclusively by the state, completely debt-free, and bank deposits are fully backed by sovereign reserves. To make this work, banks would have to strictly separate your everyday transaction deposits from risk-bearing investment funds. And this brilliantly illustrates the stark structural difference between the two. In the fractional reserve model, you've got these massive amounts of credit and digital money balancing precariously on top of a tiny, tiny reserve base. But the full reserve model requires banks to hold 100% reserves at the central bank for all demand deposits, meaning if you have money in a checking account, that money sits safely in reserve. It cannot be lent out.
This brings up the concept of sovereign money. Under this proposal, sovereign money is created by the state for public objectives, rather than by a private bank just looking to make a profit. By separating the medium of exchange, your everyday spending money, from credit, bank lending fundamentally changes. Under full reserve banking, if a bank wants to issue a loan, it actually has to attract real savings into an investment account first. So lending becomes a simple transfer of existing purchasing power, not the creation of brand new money out of nowhere.
All right, let's transition over to Section 4, Pakistan and Islamic economics, where the authors apply this global theory directly to Pakistan's ongoing financial crisis. To really grasp the urgency of this for Pakistan, just look at this staggering reality. 47%, that's almost half of Pakistan's entire annual budget, completely consumed by interest payments. And importantly, the vast majority of that, about 88%, goes straight to domestic creditors. We're talking primarily about commercial banks right there within the country.
You can see the massive fiscal drain right here. Those interest payments completely dwarf all other expenditures. I mean, the next biggest item on the list is defense, sitting at just 15%. The book argues that by transitioning to a full reserve banking system, Pakistan could effectively eliminate domestic interest payments altogether. This would create huge fiscal savings, an estimated 5.8 trillion rupees every single year, which frees up a massive amount of capital for things like education, health, and public infrastructure.
Furthermore, the authors directly link this monetary reform to Islamic financial principles. You see, the fractional reserve system essentially sells purchasing power that was created at practically zero cost. Full reserve banking, on the other hand, aligns perfectly with Islamic concepts of true risk sharing, like mudaraba and musharaka. It's about restoring fairness by ensuring that finance acts strictly as an intermediary, matching real savers up with real investments, rather than acting as a money creator that just extracts wealth from the broader economy.
Okay, we've covered a lot of ground. Let's bring it home with Section 5, breaking the cycle.
So the absolutely crucial point here is this. Khalil Omar argued that just treating the symptoms of our economic woes, whether that's hiking interest rates to fight off inflation or bailing out failing banks, it's never going to work in the long run. Their overarching message is that true economic stability requires stripping commercial banks of the privilege of money creation. Basically, banking needs to return to being a service of genuine intermediation, facilitating real economic growth rather than just endlessly inflating debt bubbles.
Which leaves us with this final, really important thought to ponder today. If the very design of fractional reserve banking mathematically leads to mounting debt, extreme wealth inequality, and persistent inflation, can full reserve banking break the cycle? Is separating our money from debt the ultimate solution to our global economic challenges? It's a massive question, and one that is definitely worth exploring further. Thanks for joining me on this explainer, and keep asking questions.